Hi there, welcome to a Kneppy Invest and welcome to a sound loan answer and question video, part 2 to this particular question from Just Jim Kramer. I've already answered, please share your thoughts on momentum trading. I'm not sure I completely shared my absolute thoughts, but I did provide a little bit of information on momentum trading and we saw what ChatGPT thought. And I do think there is some validity around this particular type of strategy. It makes sense to me. But in today's video, I'm going to be talking about the MTUM Momentum Strategy ETF. Now, there is an MTUM in the United States, but there's also a Betashares MTUM you can buy on the ASX. So I'm going to be primarily focused on that particular ETF. So let's have a look at it right now. Okay, so here's the particular MTUM iShares ETF. It's been around since about 2013, if I remember correctly, and it has beaten the market. It has been in the market. In fact, they do have the performance of this particular ETF since inception, and total return 14.82% per year. And that has beaten the market, if I remember correctly, because I did read a paper on this particular the performance of this particular ETF compared to the market. Okay, so I'm not going to talk about this particular ETF. I'm pretty sure that just Jim Cramer was talking about this particular ETF on the ASX from Betashares. A few questions I do have around this particular ETF, how active they are, those sort of things, and the sort of companies that are currently within this ETF. And I would have expected like CBA to be the biggest holding. And I think asking the question, how active are they, is really important, because if a company, or if they don't change the makeup of the particular ETF until for another 6 months or so, say they change the makeup every 6 months, or maybe even 12 months, then a company that has really good momentum could significantly change within that time. And all it takes is one bad piece of news and the share price could plunge. So that's probably the main question I would have when it comes to this particular ETF. How active are they? And then someone would say, well, isn't the whole point of ETFs being passive? Isn't passiveness and ETFs go hand in hand? So yeah, that is actually another question. How active should ETFs be? Now, I'm not the biggest fan of ETFs for my own personal investing journey. It's just not for me. I prefer to invest in individual companies, but I can definitely see the attractiveness of ETFs. I definitely see it, particularly for those investors who want to be more passive. So again, is this too active for an ETF? But if it significantly beats the market, then who cares? Okay, so this particular ETF aims to track the performance of an index before fees and expenses, comprising a portfolio of Australian companies with above average momentum scores as measured by risk-adjusted returns, which is another thing I want to know is how do they come up with, what is their measure? What is their momentum measure? That sort of thing. What's our criteria? Is it the ASX 200, ASX 300, that sort of thing? Anyway, in the fund strategy, they do mention that this particular index ranks 200 of the largest stocks on the ASX. So straight away, ASX 200. First question. By their 6 and 12-month risk-adjusted returns and selects the top 50 stocks based on those rankings at each selection day. And what is a selection day? I have no idea at this point in time. This selection process is repeated every 2 months. So does that mean they change the makeup of this portfolio every 2 months? I was thinking 3 months. That would be a nice time to change the makeup of the portfolio. So they're going with 2 months. I'm okay with that. The final portfolio comprises the top 50 stocks selected on each of the last 4 selection days. Again, I'm not sure what this selection day is. Is it just the last 4 days every 2 months? Anyway, this typically results in a portfolio of around 90 stocks with a mix of partial and full weighting allocations, depending on how consistently each stock has ranked in the top 50 over the 4 selections day. Any stock that is ranked in the lowest 10% based on its 6-month total return at the latest selection day is removed from the final portfolio. Anyway, so it does sound fairly complicated. So this is definitely not passive. A lot of activeness within this particular ETF, but I'm not sure if I have a problem with that, but it does go against what ETFs should be, I suppose. But I suppose it can change. ETFs do change, and they will keep on changing. Okay. Uh, duh, 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 duh. Um, what I wanted to now look at is holdings and allocation. I suppose you could look at key facts, pricing information, fees, management fee and cost at 0.35%, distribution frequency semi-annual. That might be important for some people. Maybe net assets is important as well. Trading information, where we already know the ASX code is MTUM. Here's the performance. Now, this hasn't been around for very long. In fact, I'll tell you right now, unlike the MTUM in the United States, it's been around for over 10 years. The MTUM Betashares ETF on the ASX has been around for, looks like, just over a year based off this. Just over a year. So we don't really have much indication of how successful this strategy would be. Now, they do have a 1 year, 3 months, 6 months, 1 year, 3 year, 5 year, 10 year, but that is the index, not the fund. But since inception, per annum up 17.51%. S&P ASX 200 up 13.71%. So if you just have a look at the fund performance versus the S&P ASX 200, it has been outperforming pretty nicely over last year. And if you have a look at the index, that has been outperforming the ASX 200 as well over the last 10 years, 11.1% versus 8.65%. Yeah, inception date was the 22nd of July, 2024. So this only been around for 1 year. But I'll be honest with you, I don't mind this particular ETF just because momentum strategies do work. History or evidence has shown that. Okay, here is the holdings. This is what I like to say. Now, this makes sense, CBA. But the weighting here, this is probably a question I do have, is do they have a higher weighting towards the bigger companies or bigger companies in the ASX 200? I'm not sure if I would agree with that sort of strategy. Maybe it should be equal weighted, but it does seem based off this with CBA almost 9.4, when almost, not almost, it is 9.4% of this particular ETF. I probably do have a slight problem with that. Westpac is the second biggest holding. Wesfarmers third, Telstra, Brambles, Aristocrat. I can definitely understand why they have these companies within this portfolio because all these companies are trending up. Now, I would also like to say that these are the sort of companies I would own for the long term. Most of these are not sort of companies you own for the long term. But in momentum trading, you don't own them for the long term. You own them until the sentiment starts to shift. So the only companies I'd probably or might own for the long term here are Wesfarmers, Aristocrat, and there's a fair few here. And we have JB Hi-Fi, Technology One, Pro Medicus, Zero. So they do have what I would define as some high-quality companies here. But high-quality companies should be in this particular ETF for most of the time because over time, the share prices of these companies should rise. I'd just like to see a different weighting. Anyway, so no shocks what's in here. Life 360 is in here. Telix, well, Telix. So this is interesting because Telix Pharmaceuticals sentiment has definitely shifted to be more negative. So I'm just wondering, and that shift has been recently as well, within the last 2 or 3 months. So maybe having a shorter time frame when they change the makeup of the portfolio. I don't know. That's for them to decide. Anyway, so every single company sort of here makes sense. Some of these maybe not because definitely the sentiment in some of these companies have started to shift more negative. Northern Star Resources, that's one of them. But the weighting here is fairly low. So that's probably my first little concern would be there's too much, in my opinion, there's a little bit too much weighting to the bigger companies, including CBA and Westpac. And those two companies are 17.7% of this particular ETF. Just because they're bigger doesn't mean they're better. Doesn't mean, yeah, I don't understand that sort of strategy. Okay, I think that's all I have for this particular, by the way, let's have a look at the chart. Chart looks good. Yeah, but it's a short time frame. It's a short time frame, so we don't really know. But based off the MTUM, in fact, what I might do, MTUM, I might go to the MTUM iShares, and I'm wondering if I should just compare it to the S&P 500. We'll get rid of the moving averages. S&P Oh, you know, I did that wrong. Okay. Okay, so if we have a look at this, in fact, what I might do is have a look at the weekly chart. And oh no, we can't go back past 2013. Anyway, so this is looking at the S&P 500 plus the MTUM momentum ETF, and the momentum ETF has gone up 360% since 2013 or assumption, and the S&P 500 has gone up 280%. So it definitely has beaten the market or the benchmark, but not by a significant amount. Not by a significant amount, but still it has beaten the market, and that's the main thing you want to see. But that's just the price. That doesn't include dividends, by the way. Okay, so that's all I really have for this video. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.